This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, it's Best Buy's move that nobody saw coming. And we keep hearing from political elites and policymakers how the U.S. labor market is strong and robust and is going to drive the U.S. economy higher and going into next year. And what we just saw out of Best Buy, well, it has an ominous warning sign for retailers all over the country. Plus, we're seeing now panic from the highest levels in China as Beijing lays down the law with its banks. And we're seeing further signs of issues in the German economy. Also, at the highest levels, the issues now facing the German government are going to face all governments during the next downturn, and it's not going to be pretty. And we continue to see declines in demand that's coming out of one of our biggest trading partners who's seen an unexpected slump in their data. And with that, let's over to Bloomberg, where we picked today's story up with a headline: China's stimulus-led property rally meets skeptical investors. Now, this headline by itself actually doesn't tell us a whole lot of interesting details. But as we dig into this report, it tells us exactly what is wrong with the global economy. It's an issue that we have been bringing to your attention on this show for the past year or more. And now we're seeing even more signs of stress on the Chinese property developers, which are in turn causing major stress on the Chinese banking system. And finally, Beijing's waking up to reality. As Wanda Properties proposed 11-month extension of a 7.25%, here's a big word, dollar bond to December 2024, also dampened sentiment. And so what we're seeing here in China is exactly what happens when central bankers invert money curves, invert yield curves, and constrain the growth of credit. Because it's important to understand, where are dollars created? Well, if you said the U.S. commercial banking system, you've got it right. Now, the question then becomes, is how do countries like China get them? Well, it's through trade. And so what you're seeing is Wanda Properties, just like we saw with Evergrande and the other property developers that are struggling with their dollar-denominated bonds, they are short dollars. The reason we're short dollars is the global economy is slowing and is not getting any better. The company was once seen among the few high-quality Chinese issuers in the junk bond market because it focuses on commercial real estate and asset-light property management business. But in a world where there's a shortage of dollars and they're not circulating around the world at a fast enough pace, well, it doesn't matter what you've done, you're still going to be at the mercy of the almighty greenback. And sure enough, the evidence that this is a problem could be visibly seen right here in this chart as we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. Now, it's important to understand is when banks tighten lending standards, it means they lend less. They make it more difficult for people to get loans, and so in the end, they lend less. And so when there's less dollars circulating out in the global economy and being moved around the world through global trade, what we should see and what we want to find in the data is a spike in the dollar, because of what it means is there's still demand for the dollar because we have dollar-denominated debt all over the world. And so without enough dollars created to support that debt, we should see demand increase in the dollar as well. And sure enough, what we see on this chart is a nominal broad US dollar index in red, that as banks tighten lending standards, here you can see highlighted in yellow, the dollar shoots higher and then finally gives up some of its steam and heads lower. We're going to show you why that happens in a moment, because the case should be, well, if banks continue to tighten lending standards, which they're doing at any point above the horizontal black line. Keep in mind they tighten at a faster rate when the line's going up, tighten at a slower rate when it's going down. The case should argue that shouldn't the dollar be headed higher? Well, that's a good point, but hang tight, because what we see in every instance as banks tighten lending standards, the dollar goes up. That puts stress on the global financial system. Now we're starting to see signs that the dollar's coming down. Of course, the first question would point to, well, it has to do with the Fed, because everybody thinks the Federal Reserve controls the value of the dollar, including the Federal Reserve. Of course, they've got it wrong. The media's got it wrong. Financial industry's got it wrong. They don't have any control of the dollar. They wish they did. And sure enough, the evidence is very clear that you can see during the global financial crisis, the dollar took off. The Fed was already at zero for a while before finally the dollar started losing some steam and coming off that high. And sure enough, we see it during the pandemic. Fed was already at zero and the dollar still was going up. And you see it here again. The dollar's coming down. The Fed isn't doing anything. Fed's just doing a whole lot of nothing at this point. The issue has to do with imports because the way dollars get around the world is through imports to the United States because we pay for goods and services with the almighty dollar. And when demand goes down from U.S. consumers, what eventually happens is demand from the dollar goes down. And when demand for a currency falls, well, as we know, the price falls. And sure enough, here we can see imports of goods and services in blue on a year-on-year rate of change. And notice how imports fall, contract, go below that black line. And next thing you know, after a while, the dollar gives up steam as, well, demand for dollars goes away. You can see it here going into the pandemic. The same effect happens. And we're starting to see the early signs of it now that financial conditions tightened, drove the dollar up. But due to demand declining, well, there just isn't as much demand for dollars. And that makes a case for a weaker dollar here going forward. But the issue then comes back to the banks, as it always does, and China's figured it out. And here comes Beijing laying down the hammer on the banks. As China guides banks to cap early 2024 loans, shift some of that forward. So here the idea is there's a problem. There's not enough lending going on to support the economy. They realize that they can't cut rates, as we talked about, because they falsely believe that cutting rates will lead to a weaker yuan. Has nothing to do with it. Has everything to do with the fact that no one needs yuan right now because it's an issue of global trade. And so what we're seeing is Beijing try to pull forward some of that lending that hits in the first quarter, and this time they're not playing nice. The People's Bank of China last week guided lenders to make sure the value of new loans they extend in January to March does not exceed the quarterly average issued over the past 5 years. The guidance from the PBOC implies a limit in the first quarter of 7.9 trillion yuan, and that means they've got to get some of those loans pulled forward. That's a quarter less than the amount in the first 3 months of 2023. And sure enough, banks will be given incentives to move forward some of these lending projects to the final months of this year. The plans may be adjusted based on the economy's performance, they added. And sure enough, here you can see Beijing coming in strong to pull forward some of that lending demand because they're concerned. This is all about the health of the banks. If the banks aren't getting enough loans, they've got an issue. How do banks make money? They lend. A simple story here. China's figuring out, as we've told you on the show, property developers start to go down. The banks follow with it. What do you do when you realize you can't bail out all of your banks? Well, maybe you will. You pull forward some of that demand, hopefully get some of your bank earnings to rise and profits to rise heading into what you already know is going to be a strong first quarter. Now let's turn over to Germany, where the government is facing an issue. And this is an interesting issue because many of you are concerned about this, as I see in the comments. And when you see the timing of what's going to happen in the global economy and what governments are going to be doing with all this debt, the two don't work together at all. As German budget crisis deepens with freeze on new spending. Now, I want you to understand that in a debt-based economy, in a Keynesian world here, what happens is governments are supposed to spend more money in a downturn to stimulate the economy. But what happens is when we see all of this debt from the pandemic that's stacked up and you see a slowdown, governments all of a sudden run into a servicing issue. Of course, we know central bankers will be back at zero and probably somewhere negative by that point. So that will help a lot. But it means they have to restrain their spending. There's going to be a lot of pressure on these governments because the global economy will not be strong enough to support these massive deficits. And at a time when you want to stimulate to get out of a slump, the governments are going to be on ice. But one thing that you shouldn't be having a crisis on, well, that's your trading account. Let's talk about a trade we mentioned on our show on Sunday. And I want to show you just how easy it is to use our reports. Some of you say, well, Steve, but the market's not going down. Look, the answer is you can make money in all directions of the market. That's what our tools help you do. Let's take a look at this one. Back on November 17th, we saw GLD on our CTA Timer Pro report, after it had sold down a bit, start to move higher. Now, we look at machine positioning. So when you see prices, machine positioning come down and settle and then rally, and we told you on the Sunday show, this was a likely case of machines where he showed you the trigger points. And look at this, Momentum Time Pro, our technical indicator report. This was the golden piece of the two. We noticed on 11/17, we got one daily count. This thing looks at all those technical signals, those RSIs and MACDs and Stotch and all those things, and smooths them all out. And we saw a pair here. We saw one daily count on the momentum. We saw the machine positioning rising. We knew the trigger points were coming. And check this out. And we would have bought if you followed the report. We showed you this on our Sunday store. So buy it open on 11/17. You actually lost money the first 2 days. I know some of you shaking your head and say, yeah, see, it doesn't work. Well, it works pretty well. You see a big gap up move at the time of recording, up 1.05%. I'm going to throw out 3 coupon codes for a free month for each of those. Some of you are saying, Steve, I go and try to sign up. The coupon code is blacked out. How come? Because somebody beat you to it. You got to jump on it quick. And something that we now head back over to Germany, as the chancellor's government has been racing to work out the implications of the constitutional court judgment, which called into question hundreds of billions of euros in financing and special funds that are not part of the regular federal budget. So just think, wait till these governments don't have the tax revenue because their economies are slowing down. They've got these massive overhangs of debt because in a Keynesian model, when your economy is booming, I know this is shocking to some of you because you're thinking this is exactly what we should do, is you should pay down your debt. You should run a surplus and get ready for the next downturn. What did we actually do? We went crazy across the world spending money, and it's going to come back to haunt us in a big way. The finance ministry in Berlin on Monday froze virtually all new spending authorizations for this year as it tries to identify the broader and longer-term impact. Only imagine if there's a spending freeze during the next downturn, what it will mean. But as we now head over to Canada, inflation slows to 3.1%, keeping the central bank on hold. So what we're trying to do is establish here as we get into our headline story, what is the pulse of the world in terms of demand from consumers, where governments are at, where the banking system at, because when you put these all together, when we see what Best Buy is forced to do, it's going to send waves through the entire retail industry. But let's take a look here at Canada now, as the consumer price index increased 3.1% in October. But here's the key part, slowing from 3.8% back in September. That matched the median estimate in a Bloomberg survey, but that doesn't matter. We know inflation was coming down. The deceleration was largely a result of lower prices in gasoline, which we pointed out on this show. And while the largest contributors, the increase remained in mortgage interest costs, that will be an issue for, of course, in Canada, groceries and rent. We know groceries are going to come down in price over the next couple of months. We know that rents at some point are going to stabilize. But what does this mean for central bankers? Looking ahead, a weak economic backdrop should work to limit prices further in these measures and could allow the Bank of Canada to start cutting rates as early Q2 next year, giving us already signs that central bankers are going to cut rates. So the idea of what they're trying to do with central bankers, they raise rates, they want to cool off the economy, and then they're going to want to cut rates a little bit because they think that will stabilize it. Of course, we know that's not going to happen at all as inflation continues to fall. Let's take a look here at the U.S. data. We got the consumer price index shown on a year-over-year rate of change against the federal funds effective rate, and Fed, they get it wrong every time. In fact, they chase inflation lower. Here you can see back in the early 90s, inflation started coming down in a big way after the Fed cut a little bit, thinking they had it under control. And the next thing you know, they reacted, chased it lower. Same thing in the dot-com bubble. How about going into the global financial crisis? Inflation cooled way off. The Fed reacted. And then inflation rallied. The Fed started to worry as the property market came apart. And then inflation came crumbling down. The Fed was at zero. Couldn't go any further because they can't go below the lower bound, at least. Maybe not until next time. Here we can see going into the pandemic, the Fed was already cutting as inflation went down early on. And then we know inflation is going down. Central bankers really are going to be cutting in a big way in the not too distant future. And now let's head over to Korea. At least South Korea, we get another pulse on one of the biggest exporters in the world. As Korean exports show, China holds the key to sustaining a rebound. Of course, exports out of Korea. This is why I want to talk about what's going on at Best Buy and other retailers, because it tells us what is coming for the U.S. economy before it even gets here. South Korean shipments abroad rose 2.2% in value from a year earlier for the first 20 days in November, giving some people some excitement as they keep alive a growth trend after a year-long slump. But the rise was more moderate than the full-month increase of 5.1% in October, indicating the path to a full recovery could be bumpy. So nobody get the excitement here. It's like, hey, look, there's a rebound. But the problem is the rebound is a slowing trend. And that is the issue. We said after a drop in the data, we would likely see kind of a bounce. It would be transitory, and then it would start to roll over. And sure enough, this is coming right out of South Korea. And look at who they blame. This is really interesting because they say, if China had bought more, well, I'll make it real simple. If everybody buys more, it will work. And that's kind of the issue here. It's not about China. It's a global thing, as those trade numbers would have been better. Of course they would have. And while South Korea's shipments to India and the U.S. rose by double-digit figures, goods headed to China declined 2.4% from a year earlier. And if you can look at what's going on in their banking system and their property market, you get the picture that internal demand in China is going to continue to weaken. And even as China economy slows, it still accounted for the largest share of Korean shipments to 21.4%, compared with the U.S. as 19.5%. Now, why does this matter? Because if you look at what happens, imports into the U.S. here, now shown in red. This is coming from all over the world against advanced retail sales. And what happens is retail sales growth slows, imports go down, and you see that event happen here in the dot-com bubble, the global financial crisis, leading into the pandemic even, and now we see it now. And what does that mean for countries like South Korea? Well, if imports are falling to the U.S., it means exports out of their country are going to roll over and head down. That impacts the labor market. If you don't have the new orders, if you don't have the backlog of orders, then that means you end up laying people off. And that's the one thing the global economy does not need right now is layoffs, because you start to look at the big picture. Inflation slowing. That means demand's coming down. You start getting more people on unemployment, their incomes go down. Demand falls further. Next thing you know, central bankers are in full panic mode. You start to have more problems at the banks as people go into delinquency and default. The whole thing just starts to unwind. And we can see this effect of those weaker imports now coming into the data. Let's look at Lowe's first and then Best Buy. As Lowe's cuts sales outlook as homeowners take on fewer projects, sending their stock to the downside. The home improvement retailer said it now anticipates sales will total about $86 billion for the fiscal year. While it had previously expected a range of $87 billion to $89 billion, seeing demand coming down, it projects comparable sales will drop about 5% this fiscal year, worse than previously anticipated. Again, all these tight money conditions, they eventually come to roost. And this is when we talk about all these inverted yield curves and bunny curves, and people said, well, they didn't predict a recession. There's too much pandemic money in the system, my friends. It's gone now. This is all changing as we head into the final quarter of the year. In the news release, the CEO, Marvin Ellison, said Lowe's felt greater than expected pullback. How about that? By customers on discretionary projects and big ticket purchases. Look, this is something we've talked about on the show, is that inflation eats away in discretionary spending because wages are not keeping up with it. We look at the total compensation data here, and look, if you can't afford the big things, then you spend money on the small things and you cut back altogether. Lowe's is just echoing exactly what we said was likely to happen. He said sales to home professionals, though, are actually doing fine, representing 25% of his business. But now let's head over to Best Buy, who is faced now with a move that nobody said could happen, as Best Buy cuts sales forecast as holiday shoppers hunting for deals. Now you think about how they're going to spin this Black Friday, is consumers are going to be chasing deals. And why do people chase deals? They don't have the money. You know, when people are flush with money, they don't worry about saving a penny here or there. They don't worry about a coupon or a discount. Now, I know some of you love to do that, and that's great. You're always looking to make sure your dollar goes the furthest. But in times, if you want something, people just go out and buy it. And the fact that we're seeing now Best Buy having to start cutting prices, well, it's just an indicator now that this is something the political elites and the policymakers said weren't going to happen. And now it's here. As the CEO Corey Barry said in a news release, Best Buy anticipated softer sales. Wait a minute, that's not what the political elites told us were coming, of consumer electronics. But with an economic backdrop marked by high inflation and the Federal Reserve's campaign to cool down spending, as if that's what going to actually Fed can do, she said consumer demand has been even more uneven and difficult to predict. She said the retailer is ready for the holiday season and prepared for a customer who is very deal focused with promotions and deals for all budgets, essentially saying, hey, if you don't have a lot of money to spend, come to Best Buy. We've got something for you. And deals, however, have become more prevalent for consumer electronics. Barry said industry promotions and discounts, and here you see it, have risen compared to last year and the pre-pandemic fiscal year 2020. And what was happening in the fiscal year of 2020, my friends, is we were headed into a global synchronized recession. Best Buy's having to cut prices. You're going to see Lowe's, Target, all these other major retailers, Home Depot, everyone's going to start to cut prices because they're realizing the money is running out. That's not what we were told. And you think about why this leads to layoffs. It's real simple. Because inflation drove wages up. Demand goes down. Who gets cut? Well, we know it's labor. And sure enough, we look at these import price index. Here we can see if they are cutting prices. Well, that comes right into import prices because we know Best Buy is not manufacturing their TVs here. They're buying them from overseas. Here we have the consumer price index in blue against the import price index in red, both on a year-over-year rate of change. And what do we see is when import prices come crumbling down, again, when they're under that black line, well, that means that's deflation. What happens to U.S. consumer prices in blue? Well, they trend lower. Here we can see those import prices rebounded up a little bit. Now they're rolling over as we see what's going on with South Korea, all boding for what we have said is going to be a global synchronized recession. If we're lucky, it'll end up a global financial crisis. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.